Thank you, Mr. Chairman. Thank you, Ranking Member Crapo, for holding this hearing. And thank you all for being here. You know, I believe we need banks of all sizes, including community banks. Community banks are important because they increase consumer choice, they promote competition, they counteract the concentration that we have with too big to fail banks. But one of the principal benefits that community banks bring us is lending to small businesses. And I think the data show that disproportionately it is our community banks that are out there making these loans to small businesses. The smallest banks, those with $250 million or less in assets, account for only 4% of the assets in the banking industry, and yet they constitute 13.7% of all the business loans out there. So small businesses really count on these community banks. When I was working on the Congressional Oversight Panel during the crisis, we warned about the concentration in the banking industry and about the impact it would have on small business lending. And here we are 5 years out now, still worrying about concentration in the industry. So what I'd like to do is just give you a chance here, Mr. Evans, if you could talk for just a minute about the GAO's findings in your report about the impact that concentration in banking has on small business lending.
So in this particular report, when we looked at concentration, what we were trying to get at is whether the bank failures created the types of concentration concerns that would trigger potential anti-competitive effects. And so in this particular report, when we looked at it, we saw that the acquiring banks generally stepped in and limited sort of concentration levels to go above that point where we would be concerned about anti-competitive effects.
But let me push back, though, just a little bit on that, Mr. Evans, because part of the concern I have is not simply whether there is physically a bank outlet operated somewhere, but that community banks do more small business lending. And once they're swallowed up by big banks, whether they are swallowed up because they were failing or whether they were just bought up, whether they're gobbled up by the big banks, that what we see is that small banks have small businesses have much more trouble getting access to capital.
Right, and that's one of the things we really couldn't get at in this study, but we do point it out. We point out that the patterns of lending could change because of some of these acquisitions, and those institutions and borrowers likely to be most hurt would be those that rely on their local community banks for small business activity.
Good. Then let me just follow up on the question that Senator Crapo had put out on the table about how we maintain a strong environment for our community banks, because they are so important to the rest of our economy. You know, after the crisis, there was just nearly a panic about people who couldn't get access to credit. One of the responses, of course, was Dodd-Frank. But one of the concerns that I have is that in Dodd-Frank, we now have a regulatory system that, while Dodd-Frank made some distinctions between large and small banks, that small banks are still subject to many regulations that were written for the larger financial institutions. And so what I'm concerned about is that we now have a regulatory system for which many parts of it are neutral on its face, but the impact on smaller financial institutions that can't afford to hire an army of lawyers to get out and interpret these rules turns out to be crushing. So the question I want to ask, and I hope we have time I can ask it of all of you, is whether or not we are reaching a point where we should really think about a two-tiered regulatory system. Mr. Rymer, would you like to address that?
Well, yes, ma'am. To the extent I can, we haven't, again, done a lot of work in that area in terms of post-Dodd-Frank. Our focus on Dodd-Frank is, so although we have some work planned. For example, you talk about the effect of Dodd-Frank. We're planning work later this fall to look to try to make sure, to ensure that CFPB, for example, is examination efforts are coordinated with the primary federal regulators, so we don't increase regulatory burden, and that then there's clear dividing lines between CFPB responsibilities in a bank and the primary federal regulator. But I think the broader question that you're asking is, what can the regulators do and potentially the Congress to do to encourage or to improve the health and sustainability of the community bank model? Frankly, I think it's whatever we can do to encourage profitability, encourage the types of behaviors in a community bank that make it successful. The key to community banking, frankly, is profitability. The majority of banks that have evaporated from the community bank landscape have done so through merger and acquisition, and that's because the folks that own those banks chose to sell those banks, and perhaps in many cases those banks were not as profitable as they could have been. So I think enhanced profitability ultimately is got to be the focus.
Yeah, although I'm not sure we regulate that directly here in Washington. If I can just have a few more seconds, if that's all right, Mr. Chairman, I'd really like to hear Mr. Brown's comments on this, since you're there doing this at the FDIC. Have we reached a point where it's time to think about a two-tier regulatory system for our large and our small banks?
Well, Senator, the issue that you bring up is a very important one, and I think it's addressed in the supervisory process by a risk-focused supervisory system that tries to scale the nature of the supervisory process to the risk and the complexity of institutions. And it's something that it's sort of hard to write rules in advance and create thresholds that work for all cases. I think supervisors at the FDIC try very hard to make sure that the process is scaled to the risk and complexity of those institutions. I would just add that in the pre-crisis years, there definitely was a performance gap between the larger non-community banks and community banks. The non-community banks grew much faster. They earned much more money. And, of course, those were the lead-ups. They did so through
I'm sorry, can we also add to that the non-community banks were the ones that took on all the risk and crashed the economy?
Yes, I was heading in that direction.
Sort of suggests that maybe they didn't have proper oversight.
And I think the reforms in Title I and Title II of Dodd-Frank, ending too big to fail, is a very important element to leveling the playing field and making sure that the community banking sector stays vibrant in the years ahead.
All right, thank you very much. Thank you for your indulgence, Mr. Chairman.